my view for 2025 is not dramatically different from what it was in 2024. My view has been fairly dour about the state of the economy, and I've been waiting, tapping my fingers on the keyboard, waiting for that to be reflected in asset prices. And obviously that hasn't happened. And I've been very surprised to have seen the most aggressive Federal Reserve rate hikes in history, larger even in speed and magnitude than Volcker's tightening, unfold without ostensible impact. I mean, clearly there was a lot of impact. We saw a huge number of corporate bankruptcy filings. We're now seeing the increase in consumer credit card delinquencies and auto loan delinquencies. So there's plenty of stress there. But the headline markets have not really reacted at all to the tightening. In fact, their bigger response was to the Fed easing, which was kind of ironic, but not totally surprising. And so now coming into 2025, I continue to believe that the markets are massively extended relative to the underlying fundamentals. And I think now that it's clear that the Federal Reserve really has very limited runway to provide the interest rate cuts that the markets had anticipated, and that the promise of pro-growth fiscal policy isn't going to be as easy or quick to deliver upon, given what we're seeing in Washington, D.C. already. So I think that this could be a very bumpy year for the markets, for risk assets. I think that Trump has the ability to let the economy go through the pain in the short term that is going to be required to, bring our fiscal house in order and address some of these issues that he's suggested he wants to tackle, and not really have to have that knee-jerk response of, oh my gosh, what if the economy goes into recession? I'm going to have to run in with, some kind of fiscal stimulus. Javier Milei campaigned on the idea that it was going to take tremendous amount of pain for them to correct the problem faced by their economy. And because he was so forthcoming and honest and open with the public about how painful this transition was going to be, they have endured that pain. And, you haven't seen any massive civil unrest or anything. He's actually been able to implement a lot of these policies and already is righting the ship. So I think as long as Trump can communicate that there will be some short-term pain to be endured in the name of achieving these longer-term goals, I think it should be okay. That said, I'm talking about for Main Street. For Wall Street, pain is not a word that there's any patience for. I mean, it's a very short-term. Obviously, the short-termism is just so endeared to this market right now. I mean, used to be short-term was a week or, even longer. Now it's a nanosecond. So, and having discounted, again, this very seamless transition from, this overburdened regulatory state, blah, to something much more akin to what we saw in Trump 1.0, I think the markets are going to be disappointed because it's just not going to happen as smoothly or easily. And we're coming into this from valuations that are so extremely stretched already. I mean, this is one thing that's dramatically different from 2016. I mean, people forget that for the better part of a year and a half coming into the election in 2016, the S&P had gone nowhere. That's in stark contrast to the last 2 years here, where we've had these phenomenal returns in the stock market. So it just seems to me like the potential for disappointment here is massive. But again, to answer your question, I think this has the potential to set the stage for a much more sustainable long-term economic foundation for the economy. But getting from here to there is going to be far less smooth and enjoyable than the market seemed to be anticipating. I think it's interesting because there's no rationale for not shifting the messaging and letting people know that there's going to be some pain involved with all this fiscal belt tightening, presuming that they actually intend to pursue the fiscal belt tightening. So it does beg the question as to just how much fiscal discipline they actually intend to impose, and how much can Doge really accomplish. So those are open questions. As to the stock market, I mean, I think it's interesting that Trump for many, many years has really linked the stock market to the economy and said, it's a reflection of the strength in the economy. And then obviously in 2024, and when it was going up, said the markets are anticipating his victory and that would be, bullish for the economy. And that's what the markets were saying. So I'm not a political wonk or anything like that. And I'm certainly not advising the incoming president. But if I were, I would strongly encourage him to stop gloating about the stock market, because when it goes down, he's going to have to own that as well. And I think it would be far better for him to just say, look, we're going to pursue all the policies outlined, that he ran on, and the stock market's going to react the way it's going to react, but that these policies are ultimately in the best interest of the country, blah, blah, blah. I just think the stock market fixation may backfire on him if he doesn't shift that. I'm less focused on what Trump wants in terms of the dollar, and really more focused on the force of reflexivity itself, which I'm sure many of your viewers are familiar with. And that is just this idea that something like the dollar or interest rates or oil prices or whatever push to a point at which they sow the seeds of their own reversal. And we have seen the dollar just soar. It's now at a point where on a trade-weighted basis, it's really the highest it's been in 4 decades. So we have this massive headwind in the form of a stronger dollar. At the same time, we've got interest rates rising, and the two are obviously related. The dollar's going up in large part because interest rates are going up. But the two together create this massive headwind to growth and especially earnings for corporations. So I think I'm less focused on whatever political rhetoric or job owning the Trump administration might want to do around the dollar, and more focused on the likelihood that we've already pushed to an extreme from which the dollar is going to sow the seeds of its own decline. And that's something I expect in 2025 will be different from 2024, that we will see a reversal in the dollar, not least due to what I believe will be evidence that the economy is still really in weak shape, and that the rescue squad with all the pro-growth policies isn't going to come in soon enough to arrest that. I definitely think that if we're not at the peak in the dollar, we're pretty close, and that we will see the dollar trade lower in 2025. And importantly, I would underscore that when I'm talking about the dollar, right now I am including the DXY index. When we talk about the dollar, that's usually what people focus on, which is the dollar relative to major other reserve currencies. But the key indicator of the dollar strength is gold, obviously. So what I am saying, the subtext of what I'm saying here is that I expect another really good year for gold as sort of the inverse of the dollar. But I do think that even relative to other worthless fiat currencies, the dollar will begin to lose value as, this view that we are the best house in a bad neighborhood becomes challenged. I was going through the latest S&P global credit ratings, corporate global credit ratings, and they had a breakdown of the companies on negative watch and those that had been downgraded in the US, Europe, and Asia. And this was developed world economies. And the credit quality in the US was far and away worse, far weaker than it is in Europe and Asia. So Japan, Germany, France, whatever, which you wouldn't think that were the case when you look at the way US financial assets have massively outperformed all those peers. So the fundamentals in this country aren't nearly as strong as the markets perceive them to be, even relative to our G7 competition. And so I think that as that reality becomes clear, the dollar will definitely decline relative to those currencies as well. all of the inflation measures, whether it's the CPI, PPI, the core PCE deflator, or even this nonsense super core measure that the Fed decided to focus on when everything else wasn't going in its direction. All of them are moving higher and have been since this summer. So we've had, I think 4 back-to-back readings that have been higher than they were prior. And yet the Fed has continued to lower rates in the face of that. So right now, I don't see any disinflation whatsoever. As the economy begins to slow down under the weight of these higher interest rates and the stronger dollar, those twin drags really begin to exert their force. I do think that you might begin to see a little bit of easing, but it's not going to help Main Street. It's not like prices are going to go lower. Your bacon that went from 5 to 10 and then to 11 isn't going to go back to 5. That would take a depression. So that's going to be really hard. I think that Trump's outlined many policies that he hopes will bring down inflation. And number one would be this drill, baby, drill and trying to get oil prices down. Meanwhile, I'm looking at my screen today and oil prices are almost up to $75 a barrel again. So it's just not going to be that easy, and obviously the markets are anticipating all of the deregulation and whatnot that's going to come from his administration to get oil production up, although we're already producing a tremendous amount. So I think it's going to be very hard to see material disinflation absent a major slowdown in the economy. And the catalyst for that, I think, would be a meltdown in the financial markets. I mean, I think if you had what I anticipate will eventually happen, where you get a repricing of risk and a return to normal valuations, the reversed wealth effect could really bring down the inflation numbers. But again, I don't know that when you stroll down the aisles of the grocery store, you're going to see prices be lower. Maybe they just stop going up. While I have been negative on stocks and risk assets in general, not just stocks, but corporate credit, etc., on the idea that risk was woefully underpriced, my preferred investment has been gold. So you can criticize me for being negative on risk assets, which just gave me the middle finger last year. But where I recommended people put their money instead actually outperformed. So the gold was up 27.5% last year versus 24% for the S&P. So I take complete ownership that the risk off scenario that I forecast to happen in 2024 did not play out. And I am repurposing that forecast or carrying it forward into 2025 because I have not given up on that happening. Gold, which was that basket I put all my eggs in, was actually outperformed. So, people like myself and Dave Rosenberg and a handful of us get tarred as perma bears. He's been very bullish on treasuries for a long time and people have been giving him a lot of, about that. And for many years, they were really massively outperforming everything else. So it's not just what you say you don't like, but what you say you do like, right, that should be counted in the final tally. That will be my final word on that.